And thank you for joining us today. My name is Andrew Daphne, and I'm the Instruction and Outreach Librarian at the New Jersey State Library. And I'd like to introduce our presenter today, who is Larry Metzler. He is the president of Apogee Financial Services Group, Inc., president of the law offices of Laurent W. Metzler, president of Innovative College Funding Solutions, LLC, and president of the Morristown, New Jersey Society for Financial Awareness. His entire career has been focused exclusively on financial planning, college planning, estate planning, retirement planning, asset protection and wealth preservation planning, personal and business tax planning, and real estate matters. So he is pretty much a jack of all trades when it comes to the things that are financial related. So we'd like to welcome Larry for the presentation today. Before we get started, just a few housekeeping items to go over. We will be taking questions at the end of the program today, but you can submit them at any time using the questions box on the GoToWebinar dashboard, or you can email me directly, and my email is on the screen. It is adauphinee@njstatelib.org. And I will put that in the chat as well for everybody. There are two handouts for today. One is a copy of the PowerPoint slides, and the other one is an evaluation form from the Society of Financial Awareness. So if you could please complete that form, and you can return it to me at my email or to Larry's email. I will make sure everybody has that. We would appreciate that. At the end of this program, as well as in a follow-up email, you get a survey from GoToWebinar on behalf of the New Jersey State Library. We're just looking for your feedback, and we really take it seriously, and it does help us inform our future programming. So if you have a moment, please complete that. We'd greatly appreciate it. And if you have any personal, investment questions that you may not want to talk about today, you can contact Larry at his email address, which is lmetzler@apogeefinancial.net, or you can schedule an appointment at the Calendly link on the screen. I will make sure that I send that out to everybody as well, so you have that information. One last thing before we get started is a little rundown of the GoToWebinar dashboard for those of you who may be unfamiliar with it. You should see this dashboard on your screen. If you do not see this, look for this orange box with a white arrow either at the top left or right-hand side of your screen. That will open and close the dashboard, and it's possible that the dashboard was closed when it was open. So if you have any problems and you can't figure out and you're just trying to reach out for somebody, just click on this raise hand button here. That'll alert me that there's an issue, and I will get in contact with you directly. As I said, there are two handouts in the handout section here. You can just click on them and download them. If you have any problems using Google Chrome to download, it could be a security setting that you have in Google Chrome that's preventing you from downloading them. You can always try opening them in a different browser, or just let me know, and I'll make sure that you get a copy of them in a follow-up email after the program. And then lastly, below that, you have the questions box. So you can just type in your questions here at any time, whether maybe they're technical related or if they're related to the presentation, and then we'll answer them in due course. So that is everything I have. So it is my pleasure to turn it over to Larry now.
Thank you, Andrew. Hopefully everyone can see my screen. As Andrew has indicated, I am the chapter president for SOFA in the greater Morristown area. As we can see, SOFA basically is a 501c3 organization. They do not sell financial products. They do not recommend financial products. We are not going to be addressing any issue specifically related to any financial products by name today. If anyone has any questions from a conceptual standpoint, I'll be more than happy to address that question, but it's not buy A versus sell B. We're not going to have that discussion today. All right, so common repetitive investor scenarios in a market that we're kind of engaged in today. When the market is down, your share prices drop, but the number of shares has remained the same. So if I had 100 shares of Apple today and Apple went up $10 a share, the value of my investment goes up, the number of shares remains the same. However, if I, for example, own a mutual fund and I've checked off the block to reinvest capital gains and dividends, irrespective of what happens to the market value of that particular mutual fund today, my shares could increase simply because of my reinvestment of capital gains and dividends. In order to declare a taxable loss or a gain, the investor must what we call act on his or her account. In other words, to sell it and then hypothetically rebuy another investment. If your account has dropped in share price and you have not acted or sold the investment, the account value has just gone down or has gone up, depending on the circumstances. Buying when the market is down is almost always a wise decision. The equivocation there is do we know how far down it's going to go? And that's always the issue. So in a declining market, not necessarily is the time to bail out. They always say you want to buy into a strength or an ascending market, not a descending market. When you switch, move, or reallocate your money within the portfolio, you are acting on that account. You're first selling the existing shares, probably purchasing new shares in a different account. So if the account that you just sold is actually down, you are in fact what we call realizing the loss in that account. And you're hoping obviously that when the account that you switch to will bounce back to be equal to or greater than the shares that you sold. Rules of the game. Got a problem here with my screen. Just hold on for a second, folks. Okay, resolve that. Had a window that was blocking my view. So rules of the game. Income is what we earn during our lifetime. Most of you, depending on your status in life, will earn $2 million or more, sometimes substantially more. Wealth is what we keep after we pay taxes. Taxes basically take away from our wealth building. And what we pay in the way of debt. I have always been of the opinion, like kind of a Dave Ramsey scenario that says that consumer debt is probably the biggest thing that keeps us from wealth accumulation, more so than taxes. Oftentimes, there's not a whole lot we can do by way of taxes during the accumulation phase of our life cycle. Typically, we're kind of bound by the tax brackets that we're in and the situation that we're in. Major situation that performs our wealth accumulation is the debt that we pay. You notice the sale sign, lady walking there with all her bags of whatever she bought today. We always try to counsel our clients from the standpoint of need versus want. We all want stuff. The question really comes down to, do we really need this stuff that we want? And I'll give you an example of sometimes managing what you need versus what you want. So we have a client, let's say, that wants a new car. And let's say, for hypothetically, that new car is going to cost $30,000. However, this person could buy a 2-year-old certified, the same model, same car, for $20,000. So what's the value of wanting this new car versus needing the certified used car? Well, in my fact pattern, there's a $10,000 difference between the two. So I'm going to point you in the future to, whenever you have a need versus want scenario, you can go to what's called a future value calculator, or the value of a dollar in the future calculator. They're online. And my example here, that $10,000 difference between the new car versus the certified used car, let's say you're 20 years from retirement and you could earn 4% on that. That comes out to be an opportunity loss of $21,911.23, meaning that $30,000 car really cost you an opportunity $51,000 and change. So when you were trying to, view need versus want, those are types of situations that you want to look at, actually quantify them numerically. And oftentimes you'll take the lesser of the two evils, buy the certified used car versus the new car, simply because the used car is what we need. We don't need a new car. I used to kid my clients a lot when they would buy a new car and say, the smell of the leather wears off long after or long before, I should say, the car payments. Obviously, our behavior toward our finances create money handling habits, which puts us in or takes us out of the game. These are learned behaviors, and typically, depending how your parents and grandparents acted toward their financial well-being, oftentimes trickles down to you. It's not to say you've had bad habits, you can't get out of them. The game, as we define it, increase wealth through accumulation, reduce taxes, and stay ahead of inflation. There's always a calculation you want to do. We discussed this during our last webinar. It's called, do you have a positive rate of return on your investment? So if we have an investment that yields 2%, inflation is 1.5%, and my tax bracket is 22%, I'm actually behind. I have a negative rate of return. You always want to make sure that whatever you're investing in, net of taxes, net of inflation, is giving you a positive rate of return. With regard to your portfolios, whether they are qualified, meaning they're in a 401k, an IRA, or something along those lines, versus a personal portfolio, use diversification to lower your risk and enhance returns. Build a plan with a solid financial strategy. As we talked about last time, you may have different strategies with respect to different pots of money. Retirement could be one goal. That's a long-term goal. If you have young children, college planning may have a different time frame, therefore a different financial strategy with regard to the investments allocated toward that particular goal. If you're saving, for example, for a vacation home, for a trip, a vacation, whatever the case may be, those are typically shorter term goals, which will have a different financial strategy. All of you should contemplate having or putting together a written financial plan. I don't mean a budget, an absolute written financial plan that can look at your short-term, intermediate term, and long-term goals. That plan should be able to be printed out. If it's not, you don't have a plan, you have a concept or an idea in your head of where you want to go. The idea of having a plan that's written and is on your computer is you can then start doing what if scenarios. What if I do this? What if I do that? What is the long-term impact on any decision I make today toward my overall strategies? The goal obviously is when you retire to have enough money to live on and keep up with your lifestyle. Continuing on the game, once again, the time frame, is it short, mid, or long term? Tax consequences going in, coming out. Okay, let's just stop and look at that for a second. If we're talking about decision making or acting on your account within a tax qualified plan, once again, your 401k, any form of qualified plan, IRA, so forth and so on, any acting or any transactions that you take place within those accounts have no tax consequences, none whatsoever. Alternatively, in a personally owned account, anything that you buy or sell within a 12-month period of time generates either a short-term gain or a short-term loss, which is basically ordinary income at your marginal tax bracket. If you hold that investment longer than 12 months in a taxable account and you get a gain, it's subject in all probability to no more than 15% rate of tax, which is probably lower than your current marginal tax bracket. So make sure that you understand the differences between tax consequences within a qualified versus non-qualified account. Diversification, asset allocation. The idea of asset allocation basically is lower risk, enhanced returns in the long term. Liquidity, pet peeve. Once again, we talked about this at the last webinar. If two people are working in the household, you want to have minimally 3 months of normal living expenses. If one person is working, you want to have 6 months of normal living expenses. Any of you that have experienced sort of this COVID issue or know someone who didn't have these emergency funds, know what can happen. That's minimal. Overall, I always like to see about 9 months of emergency expenses before you start investing in other assets or other investments. So think of it this way. In order of priority, does my employer offer a match in my retirement plan? The answer is yes. Put just enough money away into that plan to maximize your match. Take whatever excess cash you have and build your liquidity fund. After you have your liquidity fund established, to the extent that you can then contribute more to your qualified plan, by all means do so. However, if you think you're five years from retirement and you think upon retirement, your tax bracket will be higher than it is now, allocate those monies toward a Roth versus into the qualified plan. Make sure you have a long-term perspective. Don't panic day to day to day. The market goes up, the market goes down, and once again, if you don't quote unquote act on your account, you haven't sustained a loss nor you have locked in a gain. Not becoming sentimental. I don't see too much of this anymore. I used to see this quite often when folks would inherit specific securities from their mom or dad. Maybe their parent worked their entire lives for a particular company and they bought stock in that company, and there's an emotional attachment. Rule of thumb is never have more than 5% of your investable net worth invested in the stock of any one company, irrespective of what you think the long-term prospects of that company may be. We all know this kind of the rule of thumb, if you will: buy low, sell high. When you're in doubt, hold. I can't stress this enough. Forget about the mob. Forget about what your mom, dad, brother, sister, aunt, uncle, cousin. Doesn't matter what they do. What they do may be relevant, I should say, hopefully, to their long-term plan. It may not be relevant to your long-term plan. Make sure you understand what you're doing, why you're doing it. Stick to your plan. Having a specific investment plan and knowing what each choice is supposed to do, that's the value, quite frankly, in having a written financial plan. You can do what-if scenarios. Key ingredients to your investment cake. Market declines happen. We're going to review those in just a couple of minutes. There have been a number of bear markets over the last 30 years. I've experienced 3 of them, major bear markets. Overall, the long-term trending has been up. You just went through the 2008, what we call the Great Recession. We saw what happened. We had a very nice clawback, if you will, and now we're ahead of the game. However, God forbid, if you had retired right around 2008, you never make that money back up again. So that's always a critical issue. Opinion: sometimes corrections are good for the market if they're small. They tend to basically take a lot of the fluff out of the market. A market correction versus a market crash obviously tends to be shorter and less severe than what we call a bear market. That's usually why investors refer to them as buying opportunities. You're buying into the recovery period. Note, most often the market's wrath descends on companies with very high stock prices relative to their earnings, or to business concepts that look great in the euphoria of a booming market, but in the end appear to have very little fundamental support. Your idea of high earnings versus stock prices is called your PE ratio, price to earnings ratio. If you're in individual stocks that do not declare a dividend, keep your PEs below 12.
Whoosh.
Yeah, whoosh. Okay. A lot of PEs today are in the 20s. But think in terms of, if you own Apple, you're up and down, but you're getting nothing of value during the up and downs. You have to sell it to realize your gains. Here's your S&P 500 during the market crashes that I've lived through. This is 86 and 87. I want to point out here, there is a typo right here. It says 1991. That should be 2001. This is the .com crash, right? This is anything with a .com on it at that particular point in time. People bought it and got crushed. Here's the Great Recession, 2008, 2009. So these were major corrections. And once again, I caution you, 5 years before retirement, you don't want to be here and have this happen to your retirement fund, or be here and have this happen to your retirement fund, or here and have this happen to your retirement fund. Because once you are required to what I call monetize your retirement portfolio, you don't have time, nor do you have the ability to make up what you lost. That's typical, not necessarily all the time. A few facts. Market timing really doesn't work. In an ideal world, we would all time the market and we would all know when to pick the winners or who the winners are. By pulling money out when it peaked, we've been investing again at the bottom. No one knows what's going to happen tomorrow, next week, or next month. We can all kind of pontificate on what we think is going to happen. Fact of the matter is, no one really knows. Asset allocation is the key to determining a portfolio's long-term strategy. What we learned last time was asset allocation typically represents 91% of the return on our portfolios. Specific security selection is about 6%, market timing about 2%, 1% other factors. So asset allocation, the mix of cash, fixed income, and securities or stocks or mutual funds, stock mutual funds, really is the sweet spot, if you will. I should point out that we're in a kind of a highly unusual situation right now, folks, in that fixed income markets are abysmal by way of returns. Right before the call, I looked up if you had $100,000 you could dump into a CD, a 5-year CD. The highest yielding 5-year certificate of deposit was 1.4%. The 30-year Treasury bonds yielding about 1.16%. So there's no quote unquote safe place to put your fixed income money and get a reasonable positive rate of return after inflation and after taxes. It creates a huge, huge dilemma. So what we have is people dumping money into the stock market who ordinarily would never be in the stock market. In my opinion, that's all it is my opinion. That exacerbates the volatility because there's people in there who obviously and probably never should be in the stock market, who are in there typically just trying to eke out a 3 or 4 or 5% dividend. So they are more nervous than the average bear, so to speak. In many instances, they're retirees. So again, in my opinion, that exacerbates the volatility of the market. Few facts. Many of us find it difficult to invest when the market's down. This quite frankly impedes our accumulation planning goals. Based on market turmoil and media hype, we choose to stay on the sidelines waiting for the right time. Well, the question always is what is the right time? Opinion, a systematic investment approach, it's called dollar cost averaging into the market may be one of the best strategies for dealing with market volatility. Whereas waiting for the right time may be poor strategy because only in hindsight we know when the right time really was. This approach has 3 major benefits. It allows you to invest regularly without agonizing over the decision each time you purchase shares. By dollar cost averaging, you end up with an average share cost that is lower than the average share price over your investment period. So let's say you want to own 100 shares of Google and you have X number of dollars to invest. As opposed to dumping it all at one time, dollar cost averaging is suggestive that it may, in fact, make sense if there's a lot of volatility in the price of Google, in my example. So here's a classic example of how dollar cost averaging works. This person had $300. They're going to invest it over a 3-month period, $100 each month. So in April, stock was trading at $10 a share. They bought 10 shares. In May, the stock went up. $100 bought them 6.7 shares. In June, the stock went down. The same $100 bought 7.7. So at the end of the 3-month period, they bought 24.4 shares. The average price per share was $12.67, $12.67. The average cost was $12.32. I'm sorry. So think in terms of from April to May, they're $100. They would have been happy if they invested it all at one time, and then in June they would have been unhappy because they would have lost money on the transaction. Dollar cost averaging also works very, very well with mutual funds as opposed to individual securities. Measuring true performance in a bear or bull market can be done in different ways. What we call the beta, that's the investment volatility to the market point of reference. So if we're talking about domestic equities, the S&P 500 is kind of the benchmark index for comparing how your particular mutual fund did versus the S&P 500. Here's a dirty little secret. If you're invested in domestic stock mutual funds, you're going to find that it never, or I should say, they never outperform the S&P 500. If you don't believe me, again, I always refer people to any of the online accounts where you can pick a mutual fund. YahooFinance.com is a good one I use. So if you're in a Dodge & Cox, let's say domestic equity fund, and you looked at the performance on a 5-year plot, 10-year plot, whatever the case may be, and then superimpose the S&P 500, inevitably you will find that the S&P outperformed your particular stock fund, your particular mutual fund. The reason for that is you're paying a what? Management fee for the right to be in that mutual fund. So by virtue of the management fee, you're going to underperform the S&P. Typically, the only way to outperform the S&P is to be in ETFs exchange traded funds, or individual stocks. Standard deviation is the measure of portfolio's total risk. So a standard deviation for the S&P 500 of a 1.5 means that particular fund basically has a greater measure of risk than a fund that had a standard deviation of 0.8. Investment strategies, passive and active. Passive, essentially, you're buying the market. That's what most of us do. Active, you're scrutinizing security analysis, attempting to find stocks that can potentially outperform the market. These are usually used by most money managers, coupled with technical and fundamental analysis. So passive is what most of us are doing. When I say most of us, not us as a company, but most people who are investing, let's say in their 401ks, because you're only permitted to invest in mutual funds. Let's look at the two types of analysis. Technical focuses on supply and demand, relies on market timing, looks at market trends, studies past pricing and sales volume activity, emphasis on market influence rather than economic. Most of you are not in the position to use technical analysis. Most money managers combine technical analysis with fundamental analysis, which is based on economic data. What's economic data we're looking at? What they call the big three of companies' health, productivity, profitability, and earnings potential. Don't get caught up in going online and say, please show me the top 50 highest yielding companies out there. And you will find companies that yield 20%, 30%. And I actually have had clients come in after the fact and say, well, I thought that was a really great idea. You want to find out how much of the company's profits are being used to pay that dividend. A great example was, I think it was called Alaska Communications. They paid out a 38 or 39% dividend. And then when you looked the company up online, it was a little shack outside of, I think, Nome, Alaska, one company, and they were paying out 80% of their profits to pay the dividend. Well, I don't want to invest in a company that's probably going to be going tomorrow. And in fact, it kind of went belly up. So don't fall into that trap either, which is chase the dividends. There are many what we call large cap, high value companies paying a 3 or 4% dividend. They've been around forever. They're very solid. They probably have PEs of around 10 to 12. Good, solid, long-term investments. When the stock market is in a decline, do evaluate specifically how each investment has performed as a result of the stock market decline. Compare performance on each security to its peers. Do selectively sell some of your losers along some of your winners if you need to raise cash assets in the near term. If you have personal portfolios, meaning not qualified, not IRAs, not 401ks, and you have some losers that you've kind of fallen out of favor with, see if you can match up your losers with your winners if you want to kind of more diversify your portfolio for tax purposes. Do continue to rebalance your portfolio if your asset allocations weighting have been altered significantly due to stock market volatility. Meaning you have a relationship between your large cap, small cap, mid cap, so forth and so on, and all of a sudden your mid cap domestic portion of your portfolio is overly weighted. You want to reallocate that accordingly to make sure that your portfolio always continues to be in balance. Do continue to monitor economic news for any fundamental change in the direction of the U.S. economy. You want to reallocate some of your investments to better accommodate a change in these fundamentals. The only problem I have with this statement is it's focused what? On the U.S. economy. Are we only going to invest our funds in the U.S. or should we be more diversified geographically? Only you can answer that question. When the stock market's in a decline, continued do's and don'ts. Don't panic. The stock market often has declined significantly, but has almost always continued upward throughout history. Yes, with the exception of those 3 bear markets, it has in fact continued to rebound, continued to go up. Don't sell your investments at the time the market declines. This will only ensure that you realize the loss immediately. This idea of realizing the loss versus recognizing the loss. Realizing the loss simply means I acted on the account, I sold something, and I bought something, or I bought something. Recognizing the loss means I recognize it for tax purposes. So I can realize a loss in my qualified portfolio without incurring a recognition of gain or loss tax-wise. Remember the old Wall Street cliche, sell into strength, not into weakness. That's still valid today, been around forever. Don't jump into the stock market with all your available cash, hoping the market has hit its bottom. For goodness sake, never, ever, ever put your emergency fund in the market, even if the market crashed yesterday. You may be wrong if the stock market continues to decline. Use dollar cost averaging if that is applicable to your situation. Don't listen to Wall Street pundits about the short-term direction of the stock market. They're often wrong about their predictions. Remember, they sell news. It's your money at risk, not theirs. Some of you may watch Jim Cramer. He's always, this is the stock of the day to buy, so forth and so on. I would say stay away from that. No one knows what's going to be happening to the market tomorrow, today, next week, next month, post-election, pre-election. No one knows. All right, folks, that's it. Time to take some questions. Does anyone have any questions?
I believe we have to wait for Andrew to provide them.
Yeah, so, all right. As we said in the beginning, if you have any questions, please send them using the question box, or I did put in the chat to everybody my email address too, so if you find that easier, you can certainly do that. So we'll do our first question. What should a person do so that they are prepared if there's a downturn when they retire?
Oh, that's a great question, Andrew. Okay, so last webinar we included that white paper, which spoke to the issue of sequence of returns risk. You want to make sure that if your retirement is within 5 years, you actually put together a plan to address that. And we do that by virtue of what if scenarios. We always talk about the concept of safe money. That's something we would talk to the clients one-on-one. You don't want to have, well, put to you this way, depending on whether or not you get a pension or not, depending on the size of the pension, depending on the amount of pension you might get in conjunction with Social Security, all these factors kind of boil down to how much do I have to get out of my investment pot, my nest egg, to maintain my standard of living as I want it to exist in retirement? What we see is people don't understand this idea of sequence of returns risk in the real world. An example I can give you, we had a person who retired from Lockheed Martin, came in the office in beginning, I think, of 2010. He was about 85% invested in the stock market, retired March of 2008. He lost 53% approximately of his investments, and he was suicidal, literally suicidal. Now, there was nothing we could do for him at that particular point in time because he had to live to a large degree on what he had left, and his consumption was basically more than he could put back into the pot. So the idea here is you want to analyze where you are, what your long-term goals and objectives are, what you see your lifestyle being in retirement. Look at the allocation of your portfolio at that particular point in time, beginning at least 5 years before your actual retirement date. So I hope that answers the question. It's basically an analysis of all of those factors to come up with how much do I have to live off this pot of money? How much do I have to draw out of it? And is that realistic given what I have left, or given what might happen if I lost 20, 30, or 40% of it?
Great, thank you, Larry.
And Andrew, briefly, I just also emailed you that document Larry was just mentioning to everyone, if you'd like to pass that out as well. The white paper.
I will make sure that everybody gets the white paper that Larry was referring to. So let's see if we have any other questions. Somebody said, great presentation. That's good. I don't see any other questions right now, but as I said, if you have maybe more personal questions that you would like some information on, I did put Larry's email in the chat, and in the follow-up email I send to everybody, I will make sure to include his email, his calendar invite link as well. If you want to schedule an appointment, I know that sometimes we don't think of things right away, or maybe there are some personal things that we don't want to share with everybody else, that a more of a one-on-one session might be better. So, but we can leave it open for a couple more minutes. Somebody asked, can you explain OR ratio again? Or PE ratio, sorry.
Oh, yeah, yeah. A PE ratio is price to earnings. So you look at what a stock is trading at, and then look at what their earnings are, and then calculate that ratio. And it used to be, back in the day, I mean, a long time ago, a PE of 10 or less meant that the stock was trading in a very, very safe zone. Conversely, back in the dot-com era of 99, 2000, 2001, you had PEs in the 50s and the 60s, because some had an infinite PE because they had no earnings. So the higher the price earnings ratio, the more fragile or the more volatile that stock will be. Think in terms of if you had to invest in a company that had its price was 10 times its earnings versus 30 times its earnings, just on a guttural level, which seems more attractive to you? And it's going to be the lower PE.
Thank you for that explanation. All right, we can give it a minute or two to see if any more questions come in. All right. Are there circumstances when you can withdraw money from a 401k without a penalty?
Yes, there are several, depending on how the plan is drafted. So there's always a hardship withdrawal, typically a medical emergency. Many plans allow for loans. If you take a loan, basically you are paying yourself back. The interest is charged is credited to your account, not to your employer's account. Be very, very careful about making withdrawals that are not loans and that are not emergency withdrawals, because they're going to be taxable to you. Depending on your age, if you're under 59 and a half, you make a withdrawal from your qualified plan. It's ordinary income plus 10%. So now, in addition to that, there are some plans that permit what they call in-service distributions of a portion of your accumulations. The reason that the companies offer them, quite candidly, is because many companies offer very, very few investment options. And there is some legal liability that attaches to the types of offerings, the type of investment offerings that are provided. So the idea of an in-service distribution is you could take a distribution rolled into an IRA and then self-direct those investments, perhaps in different funds, different stocks, different investments than would be provided to you through your employer. So 3 ways. Basically, in-service distribution has to be into the plan, emergency, typically medical, and then basically a loan. All 3 of those basically are, or I should say, 2 are non-taxable. The in-service distribution would be rolled. The Emergency, depending on the circumstances, may be taxable. And the loan is not, simply because it's a loan. So be very aware if you're taking money out of your 401k to the tax consequences. And then probably secondarily, kind of begs the question, why are you considering taking money out of the 401k? What's the purpose of it?
This next one's for me. Where will you provide contact information and additional handouts? I will be writing up a recap of this presentation and sending it out as long as with the handouts as attachments in an email to everybody who registered. So look for that in the next probably 2 days, and then that'll have all the links, the emails, everything, the attachments that you would need. So next question, with fixed income markets currently, quote, abysmal, for folks within 5 years of retirement, any advice on what to do?
Wow. Yeah. Schedule yourself for a calendar call with me so I have some information about what you're actually looking at right now, what your portfolio looks like right now. That is so personally orientated, it's impossible to answer that question directly. Again, what I see is that we have people who need to get a positive rate of return, and by virtue of where the fixed income markets are, they're investing in large cap, high value companies. AT&T, pays a 3 or 4% dividend, but by virtue of the dividend, they still are subject to what? To market volatility. AT&T does go up, right? Philip Morris goes up. All of your major companies, your so-called Dow companies, the stock market, it does fluctuate. So in order for them to get that, 3 or 4% return, they're exposing themselves to taking a hit if they have to do what? Liquidate the account to live on. Remember, the market goes up, goes down. You don't realize any recognition of gain or loss unless you do what? Sell the investment. So in some respects, that's what folks are doing. I don't necessarily advocate that. That's a case-by-case, very, very fact-specific question that goes to so many variables where the person who poses the question, what does their portfolio look like? How old are they? What are their long-term goals and objectives? How close are they to retirement? What does their retirement scenario look like? All those questions. So I don't want to avoid the question, but that is just so laden with very, very specific facts that I would need to know to answer that question directly.
Sure, and they said that they scheduled an appointment already, so that's good to hear.
And again, Andrew, that anybody can get online, schedule yourself, and we can have a chat. There's no charge for that. This is all about basically trying to help people. Quite frankly, we give away a lot of time. I think you know that. So please, by all means, don't be shy.
If a person has a financial advisor but wants a second opinion, can a person get an extensive evaluation from you for a fee?
Sure, absolutely. I got pet peeve of mine. Every person who's ever come to my workshops who has a current financial advisor, and I mean this from the bottom of my heart, okay? You want to sit yourself down in person if you can with a mask on, okay? Or on a Zoom call, better in person. Look him in the eye, him or her as it were, and ask them the following question: exactly what are you doing differently today than you did in 2008? And then watch and listen. And it will speak for itself. And if the answer is, so I moved you from the Vanguard fund to the Windsor fund, that's a non-answer. Because here's the thing, folks. Most of us, I think, feel that the markets are over the top right now. It's probability-wise, it's more likely than not that we'll have a negative correction versus a more positive extension of the market in a material way. So the question really is what is your advisor doing differently than they did back in 08 and 09? If the answer is nothing, then you need a new advisor. You know, say, what is the definition of insanity is repeating the same behavior, expecting a different result. And some of you who have experienced that are thinking, well, Larry, you know, after 08, 09, my account came back. And that's true. But here's the question. Suppose through proper planning and risk aversion, if you will,
That's enough.
your account only went down half as much as it actually did in 08 and 09. How much better off would you be right now? That's the question you want to ask yourself. To answer your question, yeah, we're more than happy to give an opinion on an analysis, but
Alrighty, well, I don't see any more questions, so we can call it here. And again, if you think of anything, please either reach out to myself or reach out to Larry. I'll make sure everybody has the contact information, as I mentioned, that follow-up email. I'd like to thank you, Larry, for a fantastic presentation. I'd like to thank everybody who attended, and be safe, be well, and hopefully you'll join us again soon.
thanks, Andrew. Appreciate it. Take
Thank
care,
you,
everybody.
Andrew.
Be safe. Be well.
Thank you, everyone who joined us today.